The broadcast is now starting. All attendees are in listen-only mode.
Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending August 25th, 2017. What I've got on the screen here is the E-mini S&P 500 futures, a daily chart. Before I jump into the details though, just a kind of a quick recap. You know, the fundamentals of the market are still very strong. I mean, we saw, as I said last weekend, Japan's GDP come in around 4% for Q2. The Eurozone came in about 2.2%. And the forecast for the US for Q3 is around 3.8%. We'll get a second pass of the US GDP coming up this week. We've got strong earnings growth because we've seen through Q2 earnings. We're about done now. And we're seeing earnings per share up almost 11%, about 10.9% year over year in Q2 of this year. The estimate, by the way, was 6.2%, so we've really exceeded the estimate. The Q3 forecast is at 6.5%, so you can see the analysts are really under forecasting as they typically do. And then Q4, they're forecasting 11.8%. So, but either way, corporate earnings are very strong, both top and bottom line. Debt or let me say it another way, interest rates are very low, so corporations are taking advantage of that fact. And the dollar is very low, so that kind of helps offshore sales, which more than 50% of sales, top line sales for the Dow and for S&P are offshore. And in the Dow's case, over 60%. So we've got fundamentally a strong market. However, we're seeing signs and a little bit of holes in the dam, so to speak. We've got year to date, we've had about 30 record closes for the S&P, and yet we're only up a little over 1%, maybe a little bit less than 1% since March of this year. So fundamentally, the markets are getting weaker. And an interesting stat I saw in Barron's, which makes sense to me, but they kind of quantified some of this, is that there's a little bit more than 50% of the companies are below their 200 EMA in the S&P. And that's happened about 24 times since 1996, all right? More than 20, 21, 22 years from ago. It's happened more than 24 times. And 23 of those 24 times, the S&P fell back to its own 200 EMA, okay? So that would mean for us, the S&P fallen to around 2350, which kind of comes in line with what I've been saying of a slight pullback of anywhere from 3 to 7%, somewhere in that range. Now, we've already pulled back just a little bit, okay? But you can see on the chart here, and I'm going to go into the details in just one second, that we're seeing this aging bull market starting to tip over just a little bit. Now, I don't think we're going to run into a bear market. I don't think that's going to happen probably until sometime in 2018. I do believe near term we can expect anywhere from a 3 to a 7% pullback. Now, just the way I define it, remember the markets officially define a correction as greater than a 10% pullback from the highs. Okay, that would be in a correction, and a bear market is officially defined as more than 20%, and more than 30% is officially defined as a crash. Now, just note that just about every bear market goes into a crash because the markets always overshoot both to the upside and to the downside. Now, I define a dip because you've heard me say for the entire year this year, we've been in a buy the dip mode. I define a dip as less than a 5% pullback. I define a pullback, meanwhile, as between 5 and 10%, right? So I'm trying to quantify just some of this language the way I've defined it. And then the market, of course, picks up at 10% for correction and bear market 20 and a crash at 30%, okay? So that's kind of what I'm looking at here. Now, we also had this past week Yellen's speech, but it was more rear view oriented than forward oriented. Most of the markets were really primed to hear what she was going to say. And in fact, when the text of her speech was released around 9:45 a.m. Eastern Standard Time, the markets actually moved up more than 10 E-mini points or 10 handles. And then it subsequently sold all of it back off again. And the markets were already up when they released the text of her speech. But then it pulled back again, and net, it actually was lower than when it was before she started her speech. And she didn't talk anything about her BS reduction. That would be U.S. balance sheet. I call it her BS strategy. As you guys know, I fondly call her Aunt B, delivering her recipe for blueberry pie, right? Is it sweet and full of fat, meaning she's very dovish, very a lot of sugar, or is it very tart and more healthily oriented, meaning hawkish? And the odds paint her as being more dovish than hawkish. So the dollar obviously sold off once the text of her speech was released. Yields on treasuries fell. Again, just showing a softness there, which pushed the bonds up just a little bit. So that's kind of what we saw this past week. But the markets are fundamentally strong. We got a forward PE ratio for the next 12 months in the S&P of about 17.9. So it's not overly rich, but it is still fairly rich. So I do believe that there's going to be less new money coming into the markets at these levels until we see a little bit of a dip or possibly a pullback. So anywhere again between 3 and 7%. And as I said, with more stocks now in the S&P, more than half stocks in the S&P below the 200 EMA on a percentage basis, 23 out of 24 times, folks, that's a pretty high ratio. The S&P went on to fall back to its EMA, where as you can see on here, the EMA on this chart is around 2350. That's the yellow line. So let's take a look at this chart. Speaking of the chart, and let's just kind of jump into this for a second. Let me just turn my drawing tool on here, and I wanted to kind of just move in and out on a couple of things here. Okay, so as you can see here, I've got this downsloping trend line right here, which really is where we're running right now. Now I could connect them and double the line and give you one of these kind of things like that. So that's the vector right now of that dip that we're under. Okay, we're not very deep into it, but we've just kind of started, and you can see these big red candles here like this. The markets just want to sell off a little bit and kind of reestablish a little bit of a better valuation given the inherent risks that are coming up in Q4. And some of the things we've got is we've got the Fed's meeting on. We're going to get the Fed policy on September 20th. The markets do not forecast a rate hike at that time. In fact, the markets don't forecast a rate hike before the end of the year. The Feds would disagree, but the markets have been right so far. And then we've got the ECB also coming up with their policy guidance, and I suspect Super Mario Draghi is going to try and talk down the euro a little bit because the gap between the euro return and the dollar return this year is just a lot harder and a lot higher than I think Draghi wants. So he'll probably cut a deal with Yellen and talk the euro down off its ledge a little bit. We also have coming up October 1st, and we haven't even seen it in the press, but we're going to see it after Labor Day weekend. For those of you that are international on this, we've got a big holiday here early, not this coming week, but the next week, Monday, the markets in the U.S. are going to be closed. And then I think kicking off from that point forward, you're going to see talk of the debt ceiling debate. And that is going to historically, the past 2 years, it hadn't really been a factor, but 3 years ago, 3 years ago, when we did have that debt ceiling debate, it really moved the market to pretty good time. So we've got a couple of things, a couple of coming issues that could, relive this forecast that could get the S&P back down to its 200 EMA, which would agree with that other stat that I talked to you about. Now, you can also see on this chart, these blue lines over here represent buyers versus sellers, and you can see at each of these major peaks here, the markets have had a big fight between the buyers and sellers, okay? Sellers won out here. Right now, the buyers have won at that level here, so we're stuck between these two levels, and if I were to just kind of draw a big line like that across the screen and all this mess, you can see here, we're down sitting on this level here. So if we break this level and come down, you can see this next level right in here is right where, statistically, given the odds, where it would say the market would go back down in here, which is where you've got all these buyers sitting here to pick up relatively good stock. Remember, the earnings growth is good. Fundamentally, the markets are sound. But they're just looking for kind of a revaluation of some of these equities to get the PEs down just a little bit, because the markets really haven't forecasted in a rate hike expansion like Yellen and the Feds have talked about. Now, if Yellen takes her foot off the accelerator from her verbiage, and we get a Trump bump in tax policy, where we get a tax break and we get some repatriation, and they get some of this infrastructure build out that the Trump administration has talked about, then we can see ourselves come back up here again. I do believe that after we get a dip, or a pullback, depending on whether it's more or less than 5%. Once we get down here, you'll see the markets probably drive back higher again, and then we're going to start to get into trouble in 2018, and then you're going to see, I believe, us turn into a much larger correction, and then eventually an attempt to bounce back. It's going to fail, and we're going to come down and go into a bear market in 2018, 2019. Okay. For now, it's going to be a little bit choppy, but we're in this dip mode. All right, so and I'm going to be guiding our members. If you're not a member of our group, I highly encourage you to come in. We're growing our international audience, and North American folks. We trade everything from equities to mostly options on equities, and on futures. So we've had a very good year so far, and I suspect it's going to get more interesting going into Q4, into 2018. So this is a little bit about what I see on this screen here. Now, if I were to let me just kind of erase everything and then take some of these things off of my screen here, and just kind of clean it up just a little bit for you right here. And let's clean it up like this. There we go. So now that I've cleaned it up, well, it came right back. Let's do it again. There we go. So, and if I come out to a weekly, you see where I've got the key fib nodes on here. And these key fib nodes coincide with the buyers and sellers. Now, if I move it back to the beginning or the summer months of basically right around 2013, you can see here, and let me just come back in here, just increase it just a little bit. You can see that we've got a couple of key things here. And Fibonacci, while I don't use it to trigger a trade, I do use it to give me an indication of possible stop points and resistance points. I believe I showed this last weekend, but it's important that I revisit it again. I got questions on it. You can see right here, this is a key pivot high. All right, so that was a pivot high right here. And this was a key pivot low down here. This high, it was a record-breaking high, in that when we hit this high here, it took over 240 some odd days to take the high out. That was a record-breaking time. Typically, when the markets make a new high, on average, it generally makes a new high within 21 trading days after that. If the series of new highs cycle gets broken, then there is a length of time before it takes out that new high again, or you go into a sideways and then a bearish market. But here it took over 400 days, over a year and a half roughly, to take out that new high. So this makes it a key pivot high. This was a key pivot low made back in January of 2016. So using these numbers, I did the fib extensions, and these are key. You could put them on your own chart. And you can see in these extensions right up at that 200 level there, right? Give or take about 10 points. So it's never an exact number. It's always a zone. You can see where we ran into resistance. And then right at that level here, which is the 618, all right, 618% extension off the prior pivot highs, we've got support here, okay? And that is roughly, if I were to look at it, sitting right around the 2350 area, near our 200 EMA, which is the area that I would target for this pullback, okay, which would make sense to me. And it would be a pullback because it'd be greater than 5%, but less than 10%. So I could see that happening in the month of September going into October, and then we kind of catch wind November, December, we move back higher, and then we start getting choppy going into getting through Q1 of next year, okay? So remember, the markets also do not have priced in a tax hike. A tax cut. So if the tax cut happens, that's good for about plus 75 S&P points up to about 150 S&P points. It's not priced into the market. That would dramatically increase corporate earnings. And if you look at the PE ratios relative to where they are now, that is kind of the estimate. So if that happens, all of this is negated and it moves higher. But that's just going to set us up still. It's not going to negate a potential bear market that I see frothing at the bid here in 2018. So right now, short of the tax hikes getting done, because remember, the markets have not forecasted it in. In fact, the markets believe they're not going to get the tax hikes done, regardless of what Trump's administration is saying. I saw an interesting article also in Barron's this weekend where, remember where it used to be risk on trade and risk off trades? Now they're calling them Trump on trades and Trump off trades. Some days he's on, some days he's off. And he can move the markets, 20, 30, 40, 50 points in a day or a week based on what he's tweeting. So this would be a Trump on tweet and a Trump off tweet. I found that, pretty funny. But anyway, this is kind of what I'm looking at the markets, guys. And I've kind of gotten out of a lot of my longs or gone neutral. We're going a little bit more to cash than normal right now, or we're adding some vol plays to the upside for vol. We're adding some puts to the downside, and we're going to be doing some more interesting trades coming up this week. So check us out if you're not a member of our group yet. I think you'll be pleased with what we're doing. So anyway, this is a weekly chart. So if I come back into the 120-minute chart, and I am going to throw the everything back on the screen again, right? Let me just get everything on the screen. You can see that downsloping trend line. Okay, this is a 2-hour chart. And you can see right here just how tough it's going to be to take it out. So this is going to be one of our R levels, which would be a resistance level coming up this week. We got a key week coming up. And my initial near-term downside is around 2410, okay? Right down in this blue colored bar here. But you can see, I said if we were to take out that prior pivot high and hold it and get some momentum behind it, then we're going to take out 2474, which was a prior pivot high, and we'll come up and challenge that. We did not. So it established this downsloping trend line, and you can see right there we ran smack dab into it and bounced hard back to the downside. We got a near-term support zone down here that for our members, I'm going to call it our S1 value. All right. And once we take that out, we're coming down to some near-term support all the way down to this area here. Okay, remember, this is the month of September. So I do believe that the odds do favor some more downward move. Now, what can precipitate that stops? If we take out this downsloping trend line and we come up, we're probably going to run into resistance here at this R1 zone, which is our first level of resistance around 2460. We can hang up here and then be trading between these two zones right here, right? Until we get something to move the markets one way or the other. Short of that, remember, we're winding down earnings, so that just tells me that there's no other news outside of good corporate earnings. So that means the odds are going to favor probably more of a downside play than an upside play, all right? And then the market's going to go into a quiet mode again until we get through the September 20th Yellen speech. So we could see the markets just kind of drift lower leading up to Yellen in the policy statement. Remember, every quarter in, she's going to do a press conference. Draghi's going to do a press conference when the ECB meets as well. I think they will meet and do their statements before Yellen. And then Yellen gets up there and gives us her recipe for blueberry pie. So Aunt B's going to put it out on the table, and whether it's going to be dovish or hawkish remains to be seen. I believe it's going to be dovish, but let's see how this thing plays itself out. And then, of course, thrown on top of all this is going to be the coming debt ceiling debate that's got to be finalized by October 1st. We haven't seen that be an issue over the past 2 years, although this time Trump has already come out and said we're gonna build a wall, or the wall funding is going to be in the budget or else. So he's just setting this thing up to make it very interesting. Now, he may be using it as a negotiating ploy. You and I don't really give a rat's what he's using it for. All we care about is the price action and what it's going to do. The tendency will be to drive price action down if he starts doing this kind of stuff. So, and Trump being Trump, it's probably going to be a Trump off kind of play, which means risk is back off the table. So this is the E-minis. This is what we're looking at. Generally, also, the more the markets go down, then the more we're into a higher correlation mode, meaning good and bad stocks will go down with it. If we look at where we are right now, the markets are again the all-time highs right now. We're 2488. The current market, the E-minis, they closed at 2442, right? So if you look at that, we're only 46 points off the all-time high. So you'd think I'm crying uncle here, all right? But I'm not. It's just we're down 1.8%. That is almost nothing. That's just a big day. That's a big down day. I've seen the markets fall more than 1.8% in one day, okay? So this is, we can get down here very quickly if some noise comes into the market. Like I said, I believe we're going to come down a little bit lower than this, and that's kind of where we're sitting. The other thing that I'm watching very closely, check out the Russell. Let me step it back to a daily chart here with the Russell. Watch this very closely, guys. This is small cap. Traditionally, small cap outperforms large cap at the beginning of a bull market cycle. Now we're going on year 8, 9 of our bull market cycle. Small cap generally outperforms. In the beginning of a bull cycle, small cap is usually up about 14%, and it almost outperforms double of a large cap at the beginning of a bull cycle. But once you get into a bull cycle, years 2, 3, 4, right, in a bullish cycle, small cap still outperforms by only by about 40 basis points, 0.4%. And then small cap starts underperforming as you start to reach the peak of a bull cycle. And then once you get into a bear cycle, it underperforms by almost 2.5%. So using that as kind of a canary in the coal mine, you can see this past week, we actually went into the red in the Russell. Now we're back up above the opening price, as you can see here in blue at 1360.30. This is the Russell futures. I mean, we're sitting at 1375. We're only 15 points north of the open price for the year. Okay, so the rut or the Russell hit a high of 1452. We're now sitting roughly at 1375. Okay, that's 77 points off of the all-time highs. We're down 5.3%. So we're already beyond the dip and into a pullback mode in the Russell. And remember what I said, the Russell is kind of like the canary in the coal mine. It tends to lead other markets. So we're down a little over 5.3% or so. Watch this very closely. Notice on this daily chart how it's the 200 EMA knocked it higher. It went below it, and then it started to move back up, and now it held. And in many respects, the 200 EMA is sitting just about right on the opening price for the year. This is where we're sitting. Elliott wave count, this would suggest, as you can see, it's projecting that the Russell is going to fall, which kind of goes in line with all the other projections I'm talking about. And then look at the Dow transports. Dow transports, again, they are off their highs as well, right? You can see the Dow transports just like the Russell bounced off the 200 EMA. The high here for the end of the ETF that tracks it is at 175.75. This thing finished at 164.46. So it's about 11.2 points off of the 175.75. So it is down more than the Russell. It's down 6.4%. This is another canary in the coal mine. Watch this one. Dow theory says that when the Dow Jones Transports makes new highs, followed subsequently by the Dow making new highs, which is what happened in July. We made new highs at the beginning of July, for the transports, and then we made new highs throughout July for the Dow. That's the Dow theory saying we're in a bull market. But when does the Dow theory say the bull market ends or it's coming to an end? If you have a large pullback and then a subsequent move higher in the transports, and then it rolls over and then undershoots its prior pivot low, which is what we're doing right here. It's holding that prior pivot low. So Dow theory suggests that we're still in a bull market, but it's starting to get aged. Okay, so this is where we're sitting. These are the guys that I'm watching very closely. Obviously, NASDAQ, since it's outperformed for the past 3 or 4 years, I do believe is subject to a bigger pullback than, say, the Dow, or the E-minis, or the Russell on a near-term basis. You can see it's holding this red line, which is the 50 EMA. Should this break, then the key for me is this prior pivot right here at 1552.25. This is the NASDAQ 100 futures. You can see we're well north of the open price, unlike the Russell, where we're sitting here at the open price roughly for 2017. So another interesting pair trade would be to short the Qs and go long IWM. So these are just some things that I'm looking at on the chart here that would make this very interesting. The other thing is, I don't need to tell you about vol. Vol finished at 11.28. I think being long vol going into the month of September is going to be an interesting play. I think vol is going to come back up over 17. Vol is almost impossible to time. It really is. If you're not long vol when it starts to pop, because it can literally pop in one day, and next thing you know, when the market's open, it's already up a point or two, and then by the time you blink and get a hot cup of coffee, it's already up another point or two after that, and now it's already made 75% of the move for the day. So you need to be looking at long vol opportunities, which our members, we're going to be doing that as well. So that's something that I'm going to be suggesting here. Treasuries and the bonds, well, as I said, Yellen was a rear view mirror speech, not a forward view. So you can see bonds are challenging its 2017 highs here, 157.08. These highs were made in June, and it's going to move up higher. I believe we're going to take them out. We're going to have a little bit of a dip, and then it's going to go higher before we have the bonds implode. I think bonds are probably much more overvalued than equities, but at the same time, we've never ever been in a situation where we've had 4.5 trillion of dollars sitting on the US balance sheet. Same thing in Europe, same thing in China, same thing in Japan. Huge stimulus money over the past 7 years, 8 years thrown at the markets globally. When all of this eventually begins to unwind, unintended consequences are going to start popping up. And they're just too numerous to mention right now. For our members, we're going to have a lot of fun with this. I remember the bear market in 2008, 2009. I actually started our user group in 2008, and some of our best years were in 08, 09, and 10 when we had that huge move lower and the huge bounce up. I don't think that's going to be fundamentally different than we see right now. We're just going to, but for the different reasons, right? The reasons that caused the imbalance in 08 and 07, 08 into 09, in March of 09 was the bottom. We're going to be a little bit different than we are here, but the Feds have nowhere to go. So get used to possibly seeing in 2018 more negative interest rates again, because the Feds have no other ammunition in their arsenal other than negative interest rates as low as we are right now. The euro, the euro has just exploded. If we look at the euro, we're up almost $1.20. Look at this. We're sitting here. In fact, we made new highs. I got to really exaggerate this move here, but that's the euro. You can see it closed at the former high here, but we actually made new highs, right? So if I move this up, that was the new high that we made before we closed right at the former highs, 119.55. Draghi's going to have to do something about this. It's gotten too out of whack compared to where he wants it to see. Now, we had played the euro nicely to the downside. In fact, I had forecast the euro go to 102. It actually went down to 104. And then the euro just took off. And we were investing in Europe with some ETFs over there, but you could see where the euro just took off. And if you look at the dollar, man, it fell hard on Friday after Yellen's comments, right? Came right back down, made new lows for 2017, right? I got to mark the chart, but you can see right here this new low right at, and let me just mark these right here like that. You can see that's where we're sitting right now. And this downsloping channel, we're actually outside this darn channel. Really just amazing to me. You can see the channel for the year. The high for the year way back here was the very first day, January 3rd, first trading day of the year on a basis of a reflation trade with Trump. And then he started having problems, and it's just been selling off ever since. I do believe at some point the dollar is going to get a wicked bounce to the upside, a very strong one. It'll be fun to trade to the upside, but don't get lulled into it. I think the euro is going to go higher. I think it's going to counter trend move a little bit, and then we're going to have it go back and assume its own trend. There is no bullish divergences in here. This is just a very weak pattern. If I take it out to a weekly chart and just kind of show you how low can the dollar go, you can see right here, we're going to come down and test the 2016 low, and then we're going to come down into this area here. You can see this huge pattern forming. It's not a head and shoulders, but if it breaks, we're going to come down and it's going to get ugly for the dollar. Now, that's going to be good for corporate earnings for the U.S., bad for Europe, because the euro is going to it's going to drive those companies, and Draghi and Yellen are going to get on the phone, and they're going to try and talk the euro off the ledge and talk the dollar up. You can expect it to happen. So this is kind of what I'm looking at for the dollar here. If it breaks 91.88 roughly, or 91, yeah, about 91.88. If it breaks that, we're going. We're going to go for a ride. I'd expect a little bit of a strong bounce back into this downsloping channel. And then I think it's going to roll over and give us a final capitulation low somewhere down below the 90s and the high 80s. And then I think it'll cry uncle, and then we'll see how it works from there. All right. The yen has been a safe haven trade for us, and we're going to continue to stay with the yen into September. You can see the yen is, since we got into it, it's been moving up as a safe haven trade, because once the markets start to get very nervous, like U.S. Treasuries, money seeks the yen. So there are trades in there that we've been playing, and I think it'll stay that way. Gold, very interesting on gold. It's sitting right at this peak level here. Until or unless we take this out, then I would be more on the sidelines. If we take it out to the upside, which I think it will do, we're in a consolidation mode, but it's a sideways consolidation. If we break 1300, you're going to see it break on volume. You can see down here that purple line is a 5 EMA, this blue line is a 20 EMA. You can see it breaking to the upside on this move up here. You can see much higher volume in gold futures. So that would presuppose Yellen is going to stay dovish, inflation is going to stay relatively benign, and the markets are going to be bouncing around or slightly pull back. So that would be a near-term forecast for gold right now. Okay, so that would be what we're looking at in gold. And then, of course, in energy and oil, what can we say? We've had 14 trades in a row where we've made money in oil. You can see this downsloping trend line. It almost looks like the same kind of pattern on the E-minis. Every time it gets up here, it runs into trouble. It just kind of floats along, and now we're at some point we're going to break, and we're going to come back up into that psychological barrier of 50. We'll probably get a run up to 52, 53, and then I think it's going to pull back again. But either way, the strategy that we're using in options is very interesting. We've been riding this thing since the entire year. We've had 14 trades in a row. We're on 15 right now, that we've been able to trade these successfully in the futures market with options on futures. So again, for those members following along, we're having a lot of fun in this one. All right, everybody, that's kind of where we're sitting right now. I hope you enjoyed the update. If you're not a member, I've got an offer here for you on our secret trader where you can follow along and join our chat room. Highly encourage you to come in and check us out. Otherwise, for our members, I'll see you tomorrow night for our weekly update coming up for this coming week, which will lead into a long holiday weekend. Everybody have a great weekend. Send out thoughts and prayers to everybody in Texas, in the U.S. with that big hurricane. Hopefully you guys will make it through without any fatalities, and hopefully things will wind down for you. It'll work out okay. Have a great weekend, everybody, and I will see our members tomorrow night for our weekly roundup. Ciao, folks.